You've probably heard that age-old market advice, buy low and sell high. Sounds incredibly easy, right? But how do you actually know what's high and what's low before you pull the trigger? Like, is a stock cheap simply because it trades for the price of, say, two fast food burgers, while another one is ridiculously expensive because a single share costs more than most people's cars? Well, it just isn't that simple. In fact, assuming a low price tag automatically means a stock is a good deal is absolutely one of the quickest ways to blow up your portfolio. So today, we're going to crack open the core mystery of true stock valuation.
Welcome to this explainer. Today, we are going to demystify stock valuation once and for all. We're going to be building a highly practical toolkit, heavily inspired by some of the most legendary investors out there, to help you figure out what a business is actually worth. Because, as Warren Buffett loves to point out, price is what you pay, but value is what you get.
Okay, here's our game plan for today. We'll start with the margin of safety, then dive into three unique valuation methods: relative valuation, discounted cash flow, and tech-assisted valuation, before bringing it all together by triangulating stock value. Let's get into it. Kicking things off with Section 1, the margin of safety, from World of Warcraft to Wall Street.
To really wrap our heads around this, let's look at a pretty relatable origin story that actually didn't start on Wall Street at all, but rather in the digital realm. Imagine you're trying to maximize your in-game gold in World of Warcraft. You pull up a database to check the average price of a rare sword across all the different servers. Now, if you spot one on your server selling for a full 50% less than that average, what do? You buy it, you flip it, and boom, you profit. Buying items at a steep discount to their intrinsic value works exactly the same way, and is honestly just as lucrative in a video game as it is in the real-world stock market.
So that 50% discount we just talked about, that is exactly what the godfather of value investing, Benjamin Graham, called a margin of safety. And why do we desperately need it? Well, because we're human. We make mistakes, and the future is, frankly, entirely unpredictable. You always need this buffer to protect your hard-earned money from your own miscalculations and just the everyday chaos of the market. You definitely don't want to buy a stock at 99% of its exact worth. You want room to breathe, right?
Moving right along to Section 2, Method 1, relative valuation, comparing the price tags. All right, our first practical tool in the kit involves comparing the price tags of companies against their historical averages. It's kind of like getting a college degree. If you pay $200,000 for it, but it bumps up your future salary by $100,000 a year, your payback period is just 2 years. That's a phenomenal deal. Stocks work the exact same way. If you buy Coca-Cola today at roughly $72 a share and it earns $2.50 per share, it is going to take 28.8 years to recoup your initial investment. This very visceral time frame is exactly what the traditional price-to-earnings, or PE, ratio represents. But since we're driving by looking through the windshield and not the rearview mirror, we also need to look at forward PE, which factors in next year's estimated earnings. Now check out what happens when we compare our baseline giant, Coca-Cola, to its peers. Coke has a forward PE of 24.3, but if we shift our focus to a lesser-known underdog, a Scottish beverage maker called AG Bar, we see it's trading at the much lower range of its peer group. In fact, if AG Bar were simply valued at the industry average, it would have a 33% upside potential. Suddenly, the underdog is looking like the much better bargain here. But hold on, before we jump the gun, how big of a margin of safety do we actually need for a company like Coke? As we wrap up relative valuation, keep this little nugget of wisdom from Warren Buffett in mind. For highly stable, incredibly predictable businesses, like selling carbonated sugar water globally, you don't necessarily need a massive 50% discount. If you are highly confident in the business's future, you can afford to accept a smaller margin of safety, maybe buying closer to 80 or 90 cents on the dollar. Why? Because the risk of being disastrously wrong is just so much lower.
Let's move to Section 3, Method 2. Discounted cash flow, the math of future money.
Okay, so while relative valuation is great, it can occasionally be skewed if an entire industry is temporarily completely overpriced. Think tech stocks back in the year 2000. That's where discounted cash flow, or DCF, comes in to really ground us mathematically. Warren Buffett brilliantly boils down this super complex model into these three beautifully simple, sequential questions. Whether you are valuing a neighborhood lemonade stand, a massive apartment building, or a multinational tech corporation, answering these three questions gives you your ultimate roadmap. To answer that first question, how much cash? We aren't just looking at standard earnings on a spreadsheet. No, we want free cash flow. This is the actual cold hard cash left over after the company pays for all its necessary investments, like new inventory or machinery. Look at the steady orange bars here showing Coca-Cola's historical performance. They've maintained a highly predictable free cash flow growth rate of about 3.5% per year. History usually rhymes, so this serves as a really solid baseline for us.
Next up, we literally forecast those cash flows out an entire decade. So, if Cola earns $10 billion today, at 4% growth, they'll be raking in roughly $14.8 billion by year 10. But obviously, companies don't just magically vanish after 10 years, right? We have to calculate a terminal value, which is an exit multiple representing all the money the company will make from year 11 until Judgment Day. For Cola, if we look at historical data, using a multiple of 33 times their free cash flow makes perfect sense as an exit valuation.
Now for question 2. When do we actually get this money? We must discount those future cash flows back to today. Why? Simply because money in your pocket today is worth way more than money tomorrow. You could just throw today's money in a savings account and earn interest. To calculate our discount rate, we can take the current 10-year Treasury yield, let's just say 4.5%, and add a 3% premium because obviously we want a better return from holding stocks than we'd get from risk-free government bonds. That gives us a 7.5% discount rate to apply to our future cash. In addressing that final question of certainty, this quote perfectly captures why we lean heavily on highly predictable companies when running these DCF models. If a company's future is as unpredictable as a coin toss, your 10-year mathematical model is literally useless. Buffett avoids fast-changing tech stocks for this exact reason. He actually prefers the absence of change. I mean, Coca-Cola's product and distribution haven't fundamentally changed in a century, which is exactly what makes those long-term mathematical forecasts incredibly reliable. All right, Section 4, Method 3, Tech-Assisted Valuation, the modern investor's calculator.
So while Warren Buffett might be able to calculate complex discounted cash flows in his head, the rest of us can thankfully use modern software tools to rapidly test our assumptions. By taking our historical data and analyst estimates and just plugging them into a tech-assisted valuation tool, we can instantly compare the projected annual returns of our two beverage companies side by side. The model processes our growth estimates, our 7.5% discount rate, taxes, the margins, all of it. For Coca-Cola, it spits out an estimated return of 6.2% per year. Not terrible, sure, but not exactly thrilling. But for AG Bar, the tool estimates a very healthy 9.3% annual return.
And here is where the math gets really exciting. We wanted a 7.5% return over the next 4.5 years, which would be a 38% total baseline return. But our software tool shows AG Bar giving us a 9.3% annual return, adding up to a massive 49% total return. That gap right there, between what we require and what the math says we'll actually get, creates a definitive 22% margin of safety. Running the tech-assisted numbers proves the underdog is undeniably the safer and, frankly, much more lucrative bet in this scenario.
Finally, Section 5, Triangulating Stock Value, bringing it all together.
Now that we've explored all three of these methods, how do you actually finalize a decision? Well, as the late, great Charlie Munger pointed out, you can't just blindly punch buttons into a computer and expect riches. The ultimate secret to stock valuation isn't about finding one single, perfect magic formula. It's a game of triangulation. You use relative valuation to get the context, you use DCF for the intrinsic hard math, and you use tech tools for rapid scenario testing. When a company looks like a phenomenal, undeniable bargain across all three of those lenses, that is exactly when you strike.
As we wrap up this explainer, I want you to take a hard look at your own portfolio. Are you relying entirely on basic PE ratios you see on Yahoo Finance? Or are you actually projecting out cash flows to find true intrinsic value? A well-rounded investor utilizes absolutely every tool at their disposal to ensure their hard-earned money is protected by a sturdy margin of safety. I'll leave you with this thought to ponder the next time you're out there hunting for value in the market. Thanks for joining me on this deep dive, and as always, keep learning.